Welcome to the Real Estate Ninja Show. I'm Kevin Cross, Foundations Realty and Cross & Associates.
And I'm Adam Hefner with First Rate Financial.
Excellent. Hey, and guess who we are? We're these guys right here. We're the Real Estate Ninjas. And we're blowing your mind with our shotgun of knowledge and awesomeness.
Flying roundhouse kicks of knowledge.
That's right straight to the esophagus.
That's right.
All right, so we've got a lot of amazing things to talk about today on the Real Estate Ninjas. Adam, why don't you start us off with what's going on with rates?
So we got some exciting things going on in the world of finance. Interest rates are back to the lowest they've ever been in the history of America. That's not as long as I've been alive or as long as Kevin's been alive. That's not as long as Alaska's been a state. That's the history of our country. Rates are back down to about 3.25% on government loans, which is absolutely fantastic news.
3.25 is lower than I would lend money to my children.
That's
they
exactly
don't get
right.
away
Yep.
at 3 1/4, and yet you can lend up to, with the new FHA loan limits, up to $750,000.
Yeah, you can get well over that. Yeah,
at 3 1/4.
It's a pretty good deal. All right, and so not only are interest rates a really good deal, not only is that really exciting, and for the record, 3.25% is the lowest that government loans ever got without paying a bunch of additional fees, points, etc. on a 30-year fixed rate mortgage, right? On top of that, what we have is we're expecting in the next couple of days an announcement from FHA, that's the Federal Housing Administration, that they are lowering the mortgage insurance premiums on FHA loans.
So as I scramble for my highlighter here, the current mortgage interest rate is based on your loan balance. So every $100,000, they want 1.38% of that is funding for mortgage insurance. So FHA, basically what FHA is it's an insurance policy. Imagine your mortgage is a truck. FHA is an insurance policy, and the insurance policy is 1.38% of whatever your loan balance is, okay? What is it going down to?
And what that means is, in a dollar figure, that means for every $100,000 that you're borrowing on your mortgage loan, you're paying about $1,300 or $1,400 per year in that annual mortgage insurance premium. So that works out to be about $110 or $120 per month.
Yeah, you're being extorted for.
Yeah.
Right? So now it's going down, and the reason is, I want you to think, again, FHA, think of it like an insurance policy. The insurance policy went up, and FHA mortgage went, when lots of people were crashing their mortgages, right? They were ditch diving, maybe they just, they jump out and they'd strategic, what they call a foreclosure, where they just run away from the vehicle and leave it on the side of the road. And so as lots of people were foreclosing, their houses were going back, mortgage insurance had to go up to pay to compensate banks for those losses.
That's exactly right. And if for those that have been paying attention to the market, the FHA mortgage insurance rates have gone up dramatically over the last 5 or 6 years. The premiums have been changed at least 5 or 6 times, which is about once per year, and those premiums are going up, 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 up. Yep. And so right now, at the current levels, before the the adjustment lower, they're about 3 times higher than they were about 5 or 6 years ago before this big crash.
That's correct.
So this is a big thing, seeing them kind of revert back.
And very rarely do you see that happen with government. Let's be honest, how often do taxes go down? But in FHA insurance, what it is less people are crashing their cars or crashing their mortgages, so there's more money, and they feel better about the stimulus and what's happened in the economy, and the chances of people, the likelihood of them crashing their cars is less. So it's going from 1.38 to what?
Down to 0.85%, which is
0.85%. Yep. I know I'm not supposed to put my back to the camera, but you're just going to have to get over it.
That's right, and that's about a 0.5% reduction. And if you look at that as like real spendable dollars, if you look at buying a single-family home in about the price range of $330,000, is that a good number for an average?
Yeah, actually, that is exactly right. So if we take this and then I just wipe it, hey, grab me that eraser real quick there, Turbo.
Magic eraser.
So there you go. He's still here. He's with us. So if you imagine that we have a mortgage balance of $300,000, like your average purchase price for a single-family home in Anchorage is $330,000. Okay. Yep. So now that we've got $330,000, your mortgage payment on $330,000, principal, interest, not including taxes, but and mortgage insurance, be about 22. What did we come up? What was the number you ran for me?
2277 is the number. That's the number you'd be paying right now. So that's right now, and this is with the new lower interest rate. So this is calculated at 3.25. That's an out-the-door payment. It includes your property taxes, your homeowner's insurance, as well as the mortgage insurance. So that's an out-the-door, everything included payment with a minimum down payment of only 3.5%. You're looking at about $11,000 or so for a down payment on that loan.
But now that we've seen the same loan, same terms, same everything, the same guy goes out and now at the new FHA loan limits, it's the exact same product, because it's lower, your new adjusted payment looks like it's going to be around $21.49.
Yep. So it's about $130 a month in right now real savings. And this is especially cool because there was a handful of people that got in when the getting was good with interest rates, and they locked in those 3.25, 3.375, and have been bragging about it for the last couple of years because that was the best that they'd ever been. Well, now if you can match the same rate, right? If
Well,
you
you
can
know
get that
what? The
same
truth
rate,
is that if you did it close, you could actually pay a slightly higher rate
you could. Yeah.
and still get a lower payment.
And still get a lower payment. And really, the payment is what matters. That's what affects your bottom line.
And you know, when people come to us and they ask, "Hey, Kev," you know, a lot of realtors will ask you how much you qualified for. That's not the correct question you should be asking yourself, and that they should be asking. They really should be asking you, what have you budgeted for monthly as a housing expense? Because that's the real number. Because it's not just going to be your mortgage payment. It is going to be utilities, homeowners' dues, you know, and on a multifamily, probably maybe vacancies, reserves. What is it that you've budgeted for?
Absolutely, that's very accurate.
So here's what that kind of looks like, and then, but not all of you are necessarily buying your average price. Maybe you're buying a fourplex, and obviously, and with an FHA loan, you can't own or occupy an investment property. And since it's an investment property, cost savings transfer into cash flow.
It does, and this is a really cool thing. A lot of people don't even know that you can use your government benefits to buy a multifamily income-producing property. And FHA is one of the easiest, most accessible ways to do that. Down payment of only 3.5%. You know, on a $550,000 loan, you're looking at $16,000, $17,000 down payment, approximately off the top of my head.
Yeah.
And as we've mentioned in past videos, you get to collect rent for the first 2 months before you ever owe a mortgage payment. So you're getting roughly half of your down payment money back in hand before you ever make a mortgage payment.
So now on this, what we've got is you have your mortgage payment of, your purchase price of $550. Your mortgage payment is going to be about $37.95. But now that FHA insurance is going down, that same interest rate, same program, everything at 0.085% is going to be a new payment of $35.81, or essentially you're going to be making $214 more money on that property.
Now, $214, that's a legitimate amount of money. That's a car payment, you know, that's
that is 85% of your average gas bill. Average gas bill on a fourplex is about $300 a month.
Yeah.
So you're figuring that right there in the loan, you've covered most of, if a little over 2/3 of just the heating bill for that income producing property.
It is phenomenal. It also should be noted that these, not only the interest rates, but also the mortgage insurance premium are fixed throughout the term of the loan. So there's no chance of it going up or increasing on you as you go forward. So once you know the biggest cost of owning that building, which is your mortgage expense, you can plan on that income, that level of income. And as we've seen, rents normally always go up. Not all of the time, but as a general rule, as time goes by, your rates are going to go, your rental rates are going to go up.
So we talked about that on the last Real Estate Ninjas. You know, we told you FHA loan limits are going up, limitations, so you can buy more property. The rate that is charging on insurance is going down, which means that you make more money, and the interest rates are staying low, which means it's the cheapest ever to borrow. Really, right now, everybody should be looking at their bank statements, looking at what they have. And if you're not investing in real estate, you need to start seriously considering it, because the largest cost against owning investment property is not, it is the debt service you pay on that loan. That's the biggest expense. It's never been lower. And if you have a house you're not even interested in selling, you need to be seriously considering refinancing it, seeing what's out there. Let me ask you, Adam, how does that affect anybody that currently that's been in a house for 3 years, that has an FHA, and maybe they're paying a 1 1/4?
That's a great question, Kevin. So what you've got is you've got a couple of different options. Depending on your equity level in the building, if you have not very much equity, limited equity, maybe you bought the building just 6 months or a year ago, all right? You could benefit from this right now. 6 months, 12 months ago, rates were 0.5% higher, if not higher, plus your MI, your mortgage insurance was higher. So you could have bought a building 6 months ago, 7 months ago. You could refinance and save money right now.
Yeah, you know, I just thought about that, and I'm so glad you pointed it out, because listen, even if you're like, well, it's 0.25% lower than what I did last year, it's not worth refinancing, you're only looking at the interest rate. The other half of that was, what was FHA mortgage insurance when you bought it, and what were you locked in at, and what is your new locked rate? Well, if it's gone down 0.5, like 0.5%, Man, that's significant savings. Couple that with a lower 0.25%, it may, if you plan on being in that house another 3 years or so, it could be a significant cost savings to actually consider refinancing.
Absolutely. Another thing that you can do is if you've had your home for 2, 3, 4 years or something like that, and you're on an FHA loan, you've been paying that increased mortgage insurance premium. What we've been doing to those folks, because you have a little bit more equity in your home after paying a couple years on your mortgage, you can refinance into a conventional loan, and we can do something called lender-paid mortgage insurance. And this is a way that you can structure a conventional loan where you don't pay any monthly mortgage insurance. And full disclosure, my mortgage is structured that way.
Mine's is structured that way.
Kevin's is structured that way, so all the cool kids are doing it, all right?
Well, and you know what's funny is that you don't have any mortgage insurance. You pay a slightly higher interest rate, but what's the only part of your mortgage payment that's deductible?
It's a mortgage interest rate.
It's the interest rate. So even though I pay a slightly higher interest rate, that's deductible. And
the overall payment is a lot less too. So if you take someone with an FHA loan, even if you got a really smoking interest rate, low to mid 3% range, but you're paying $300 to $400 a month in mortgage insurance, you can roll that into a conventional loan. Yeah, the rate might go up a smidgen, but your payment's going to go down $300 or $400. And come on, that's what really matters.
So you need to be talking to a lender right now, particularly this guy right here, Adam Hefner, at 222-5505.
That's right.
Put your number up there.
That's right.
222-5505. There you go. That's maybe too small for him to see, but that's okay.
Our readers, our viewers,
you know
have great
right
eyes.
now, Julia is going to put it in like big bold.
That's
at the
right,
bottom
exactly.
Of the video.
Yeah, it's flying across.
And then you got Foundations Realty 865-6529.
Yep.
Talk about that strategic approach. Really, it's buying property, refinancing your house, purchasing a home. Man, it's like playing chess. There are a lot of pieces. And you would definitely, if you were going to be playing chess, you would want to have Bobby Fischer on your side, wouldn't you?
Right, yep.
We're like the Bobby Fischer of real estate.
Yep.
So,
another thing just to keep in mind is most people look at buying a home, selling a home, refinancing a home when there's some sort of need or urgency in their life. All right, and when you come to a professional such as myself or Kevin in a position of need, we'll help you out. We'll get you the best deal, but you're not going to get to take advantage of the best market conditions because you're in a rush. Right, so the guys that get the best deals are the ones that stay in communication with Kevin and I on a regular basis, so that when this kind of stuff happens, you are the first to know.
You're absolutely right, Adam. And this is I'm so glad you pointed that out. Let's be honest. When you're buying a house, it's because, listen, maybe I relocated to an area, I just got married, we got kids on the way, there's something big that's happening, so there's already that stress involved. If you're selling a house, you're downsizing, there's something happened, maybe it's a worst case scenario, you lost your job or something happened, and that's why we say typically at weak moments, people end up with either weak realtors or weak lenders. Why? Because the need arises, and what do? It's like they just open up the phone book, and that's how they end up with the guy. So now is the time you need to be talking to a real estate professional. Listen, purchasing real estate, selling real estate, refinancing your house is the largest investment you will ever make in your life. You owe it to yourself, you owe it to your family to interview that individual that's going to work their butt off for you. And Adam and I, you know what? We've got a long track record of success, and not only that, we like to make it fun.
We do. We like
and if you're going to go on that journey, why not make money and make fun?
That's right. All right, thanks, guys. We appreciate you joining us. We are the Real Estate Ninjas.
Kevin Cross, Foundations Real Estate at Keller Williams, 865-6529.
Adam Hefner, First Rate Financial, 222-5505.
All right, man. Go be awesome.